If you feel like you're behind on your retirement savings, you're just trying to get something started, get something started. Don't feel like you've got to put the maximum amount into every type of account or any whatever accounts you might have available to you. And one of the practical things you can think about is taking advantage of these auto enrollment features a lot of 401k plans offer now, or these auto increase options, where even if you just start, it'll automatically increase you by 1% the following year, or whatever increments may be established by your plan. Welcome to another episode of the Simply Retirement Podcast, where we want to empower and educate women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner with over 25 years of experience, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. Joining me once again is Wendy McConnell. Wendy, how are you?
I'm good. How are you?
I am very well. So I wanted to share with the audience, the first time you and I have actually got to meet in person happened just recently, about a week ago.
Yes.
So it was awesome getting to meet you and your sister and get a chance to chat about everyday life. And it was really cool.
Yeah, well, I mean, of course it was. It's me.
You were there. That's all that matters.
I'm delightful. No, it was very, very nice to meet you and your wife. And, it was a great little get together. So thank you for making yourself available.
Even though you and your sister both had Philadelphia Eagles shirts on, we let you pass with that.
When I was when I was in the airport, when I was leaving, somebody went, "Yo, Eagles fan, you want to sign up for this?" I'm like, "No, I'm good, thanks." So it was a running theme throughout my trip to Texas. But thank you for having us.
Yeah, it was great to see you again in person. We're approaching the 3-year mark, so this is the first time we've actually gotten a chance to meet in person after almost 3 years of working together here.
Yeah,
very cool. Awesome. Well, so on today's episode, we're going to be talking about the 2026 retirement plan contribution rules, including how much you can contribute to different types of accounts like 401ks and IRAs, but also how to think about prioritizing which accounts to use if you may be funding more than one type of account, or if you're not actually able to contribute the maximum to each of the options you may be contributing to. Also, though, what choices may still be available, even if you're not currently working or maybe you don't have earned income. So again, as always, for all the links and resources for this episode, please visit the simplyretirementpodcast.com. And also don't forget, if you have a question, topic idea, specific retirement challenge you'd like to hear covered on an upcoming episode, you can visit the simplyretirementpodcast.com/askeric. With all that out of the way, so I wanted to first start with the actual numbers for 2026, because this really builds on everything else. So if you are contributing to what we would call a workplace retirement plan, a 401k, 403b, 457, there's a number of different types out there, but the base contribution, everybody contribute up to $24,500 this year.
Okay.
And then if you're over age 50, you have what's called a catch-up contribution. This year, it's going to be $8,000. So a total, if you're over the age of 50, of up to $32,500. That's a big number there. Now, I want to discuss something that's relatively new as well. Actually, 2025 was the first year that this was in effect. And this was introduced as part of Secure Act 2.0, but many people are still just simply not aware of it. And there's an additional opportunity that exists. If you are between 60 and 63, there is an enhanced catch-up, which is actually up to $11,250. It's not on top of the $8,000, but it's in an alternative to the $8,000. So if you're 60, 61, 62, 63, you can contribute as a catch-up $11,250 on top of the $24,500.
Yeah.
For IRAs, and this is going to be including both traditional and Roth accounts, the 2026 contribution limit is $7,500 for everybody, and then an $1,100 catch-up if you're over the age 50. So a total of $8,600 if you're over age 50. There is no enhanced contributions for IRAs in this case.
Yeah.
Now, here's a key point with IRAs and Roths. It is that you have to have earned income to cover the contribution amount being made. In other words, as an individual, if you want to contribute that $7,500 to an IRA or to a Roth, you have to have at least $7,500 in earned income. That could be W-2 if you're an employee, it could be self-employment, but it must be earned income. So things like IRA distributions or rental income, any of those other types of incomes that you might that might pop up in your head, it has to be earned in order to make a contribution to an IRA or to a Roth.
Any particular reason why?
So actually, the part of it is that the idea behind IRAs and 401ks is the opportunity to save for retirement. So that's the origination of these particular types of accounts.
Right.
So it's based on the earned component that allows you to make those contributions. So that's really the key, is just that it's designed for a retirement savings vehicle while you're still in your working years.
Okay. Good enough.
Now, here's another important note. So this episode is going to be released in February, obviously still before April 15th of 2026, which means you still may be able to make IRA contributions or Roth contributions for the 2025 tax year, obviously depending on your situation. So if you think this might be applying to you, be sure you talk to your tax advisor, your financial advisor before that deadline to see if you still have an opportunity to contribute for 2025.
Okay.
I want to remind everybody that these numbers represent the maximum amount you are allowed to contribute. They are not the required contribution amounts. You can always contribute less, and for many people, that's exactly what will happen. And we'll talk about how to prioritize these dollars and these contributions next, but I just don't want these limits to feel overwhelming. It's actually, when you're talking about retirement planning, it's really about the progress, not the perfection. So when you're thinking about starting, if you feel like you're behind on your retirement savings, you're just trying to get something started, get something started. Don't feel like you've got to put the maximum amount into every type of account or whatever accounts you might have available to you. And one of the practical things you can think about is taking advantage of these auto enrollment features a lot of 401k plans offer now, or these auto increase options, where even if you just start, it'll automatically increase you by 1% the following year, or whatever increments may be established by your plan. But again, just allows you to get started, get something going towards retirement, and then automatically increase that over time, so that it helps you limit the worries and the decision-making factor here.
Yeah, I hear advice about, to make sure you take advantage of those catch-up years, because this, and what'd you say the one was, like 30-some thousand dollars a year? I don't have an extra $30,000 a year to put into my savings account.
And that's why it's so important to understand, number one, what the limits are. And again, that you don't have to put the full amount in to take advantage of these types of accounts. But it is very true, though, that for our audience, women over 55, where this stage of life potentially represents that beginning of that shift from your working years into those retirement years, where you're going to start to prepare for my income and what is that going to look like. But in many cases, also that represents your highest income years.
Mm-hmm.
So when you're in your 50s, you're in your early to mid 60s, a lot of times that's where you're making the most money that you've made in the past, so that you've ever made. So just understanding these limits really becomes important.
So you're saying any of the extra money that you've accumulated for promotions and raises and stuff, all that should be going to catch up. I know that's not what you're saying, but that's what people say. Yeah.
So, but I think it's about prioritizing. Obviously, it always comes down to planning. What are my goals? When do I want to retire? How much do I need? All those things come into consideration. But one of the things I talk about a lot is, think out of this 1/3, 1/3, 1/3 rule. And what I mean by that is, if you get a bonus, if you get a raise, you've done something to earn that. You should reward yourself to some extent. So you kind of think about it and say, okay, well, 1/3 is going to go to additional savings. 1/3 is going to go to Uncle Sam. And then 1/3 goes to your own enjoyment, doing something good for yourself. So kind of a basic rule of thumb. And obviously not everybody's 1/3, 1/3, 1/3, but you get the ideas. If you earn a bonus, you earn a raise, you still feel like you're rewarding yourself to some extent for that.
Okay.
But it could be the opportunity to increase your savings by that 1% or 2% as well.
Sounds good.
All right, so let's talk about prioritization, because this is where a lot of these decisions, these important decisions, come in, and also is where some of the confusion lives. So in general, what I typically encourage is you want to prioritize the type of account based on whether you believe you're in a higher or lower tax bracket today than what you expect to be in the future. And whichever one it may be, the goal is very simple. You want to pay tax at the lower rate. Okay. So when you think about Roth accounts, again, the keys here is that with Roth, you pay the taxes now on the amount you're contributing, but those withdrawals, assuming that you meet all the requirements, are tax-free in the future. Whereas traditional accounts, pre-tax accounts, you pay the taxes later. So the contributions, you might make a contribution that may reduce your taxable income today, but then those withdrawals are going to be taxed in the future when you actually start taking money out of those accounts. And so that basic framework helps guide the decisions, many of the decisions that we're going to be walking through here. And so just kind of walk through what I would consider a potential common prioritization approach might look something like this. So first, if you've got a 401k with an employer match, prioritize contributing at least enough to make sure you're getting that full match. Because obviously that match is essentially free money, and it's going to represent a 100% return on the dollars you contribute, regardless of what your investments might be or what the market's doing or anything like that. So make sure you're taking advantage of the match. Now, there's a misconception that I hear quite a bit, and that is that just because your employer doesn't match, if you happen to work for a company that doesn't match your 401k contributions, it does not automatically mean you should not contribute. For example, if you are a high earner, if you're at a high salary level, or you're in a high tax bracket as a couple, this might still be your best opportunity to reduce your taxable income, back to the prioritizations I was talking about before. Hey everyone, it's Eric. Hope you're enjoying today's episode. I want to take just a quick moment to share a resource I think you'll find valuable. Have you ever found yourself asking, how much can I put into an IRA this year? Or how much can I earn before my Social Security gets reduced? Those are the kinds of questions that come up all the time, and the answers change often more than you think. That's why we created a free 2-page tax and retirement planning cheat sheet, updated for 2026, with the key tax, Social Security, and retirement numbers all in one place. You can download it right now at the simplyretirementpodcast.com/retirement cheat sheet. It's a simple reference you can keep handy whenever questions come up. Now, back to the episode. First of all, always again, contribute at least enough to get to that match, get the 100% of the match, or work your way up to it if that circumstance applies to you as well. So once you've gotten to the full match, what I typically look at then is saying, okay, if you're eligible, next think about contributing to your Roth account. If you're below the income restrictions for Roth IRA contributions, start working on contributing to your Roth account until you've reached the maximum contribution, which again, we said was $7,500 if you're under 50, $8,600 if you're over 50. Now, if your income is too high to contribute to the Roth, this might be where you think about something called a backdoor Roth. That might make some more sense. And I'll refer you to our episode 73, where we talked all about different Roth IRAs and how to contribute to Roth IRAs for a little more detailed explanation of what a backdoor Roth is. But that might be something still to try to build that tax-free account. Now, from here, what I typically say is your decisions often then depend on your income level. So if you're a higher earner, you've gotten to the maximum matching contribution, you funded your Roth, then you might think about continuing to increase your 401k contributions to try to reach that maximum 401k limit. But if you're a lower earner, or those looking for a little more flexibility where their investments, that might be where you say, well, maybe I need to look at an after-tax account, a brokerage account. So there's no tax advantages to that, but there's also no age restriction. So there's no age 59 and a half or age 65 or 67 or 55. It gives you basically relatively easy access to your funds. But if you're in a lower tax bracket, you might also still see some tax advantages with an account like that.
Okay.
So again, flexibility and tax opportunities. Now, one core retirement savings, once you've kind of addressed all your core retirement savings opportunities, you've gotten your match, you've increased your 401k, you're maxing out your 401k, you're maxing out your Roth. That's where we start looking at what your other goals might be, such as, hey, maybe I want to retire before I'm 59 and a half. I want to retire at 55. How do we go about doing that? Again, maybe that's where that after-tax brokerage account comes into play. Or if you've got education goals, depending on if you've got your own children, or maybe you want to contribute to your grandchildren's education, maybe you focus on 529 plans or those types of things. But again, that's where we start looking at your specific goals and say, well, what would make the most sense based on what my personal goals are?
Got it.
All right. So now let's talk a little bit about the tax planning aspect. I've talked about it a little bit, but I want to walk through this just give you a little bit more content around helping you make some of these decisions. So based on the tax brackets being recently extended by the One Big Beautiful Bill Act, we know kind of what the tax rates are going to be for the next few years. So obviously there was some concern about, were tax rates going to go up? What was going to happen with tax rates? So actually that's somewhat settled, at least they're quote unquote permanent for now. Permanent until the next administration comes in or whatever the next change might be. But it does give us a little bit more opportunity to think through planning strategies and concepts. So what I would probably think about is if you're in the 12% tax bracket or lower, you might want to think about prioritizing Roth contributions. Whether that's Roth 401k, we haven't really talked about that, but a lot of 401k plans will allow you to contribute to the Roth side, not just the traditional or the pre-tax side. So if you're in the 12% tax bracket or lower, think about whether Roth contributions would make the most sense, because this is most likely the lowest tax bracket you're ever going to be in, right? If you're in the 32% tax bracket or higher, this might be where you think about pre-tax or traditional contributions, unless you really have a specific reason to believe your future tax rates are going to be higher. And this is really something from a planning perspective. This is a lot of where some of the confusion can come in that people often automatically think that I'm going to be in a lower tax bracket in retirement. But that's often not the case, because most people want to at least maintain their lifestyle. They don't want to have to drastically cut back on everything when they retire. So it does actually happen quite a bit that you end up being in a very similar tax bracket or maybe slightly lower, but it's not on. I wouldn't make that an automatic assumption that's going to be the case.
That's what I was told most of my life, that's why I should wait, because my tax bracket would be at the lowest when I retired. So clearly not the best advice.
Well, and again, that's where understanding the importance of tax planning and doing tax projections. We talk a lot about minimizing or limiting or reducing your lifetime tax liability. The only way to do that is do tax projections to say, well, let's look at 2026. What are the most effective strategies I can use this year?
Okay.
But where do I think I'm going to be 5 years from now and 10 years from now and 15 years from now? Because again, the assumption is, we've been talking about the potential for tax rates going up for a long time, but they haven't done so far. And now again, we've got quote unquote permanent tax rates.
Semi-permanent for just a little bit.
Permanent tax rate. But again, that's where you say, okay, based on what would have happened with the tax rates is that had the Tax Cuts and Jobs Act expired as it was set to do, the 12% tax bracket would have been the 15, the 22 would have been the 25, so on and so forth. So again, if you think about me, is that going to be the direction we're going to go 3 years from now or 8 years from now, whatever it might be? Is that okay? Is it the likelihood that 12 will go to the 15? Back to my point about if you're in the 12% tax bracket, you may very well be in the lowest tax bracket you'll ever be in again. That's why the Roth, paying the taxes at 12% today to avoid paying 15 or 22 or 25 or whatever it might be in the future, that's where that comes into play.
Okay.
Now, where it can get a little bit tricky is if you're in that 22 to 24% tax brackets, which a lot of people fall in that area. Because again, when we know I would still call it uncertainty about what future tax rates are going to be. And that's really where you say, well, maybe in those particular tax brackets, there's not a huge variation, because the next increase for our current tax rates in 2026 goes from 24 to 32. That's a big jump.
Yeah.
So when we're thinking about these different tax rates, that's where we say, okay, which is going to make the most sense based on my personal circumstances? What tax bracket am I in this year? Where tax bracket do I think I might be in 5 years or 10 years from now? Now, again, if you're in that 22 to 24, there's not a huge variation, but that's where you say, maybe I choose the Roth, because as that saying goes, the devil you may know today is better than the ones you don't know in the future.
Okay.
So that's where, again, you might say trying to figure out, again, using that as best you can, am I going to be in a higher or lower tax bracket today versus what I think I'll be in the future or in retirement? This is really where, again, one of those areas where the coordination with your tax advisor, with your financial advisor, can be especially helpful. Now, here's what I can expect might jump up and catch some people here. So we're talking about these Roth contributions and pre-tax traditional contributions. A really key rule kicks in this year in 2026. This actually came from Secure Act 2.0. If your prior wages for 2025 were $150,000 or more, any 401k contributions, catch-up contributions, must now be made to the Roth side of the plan rather than the pre-taxes they have been in the past. So we talked about that $8,000 is used at age 50. Somebody's employed, they're age 50 plus. They want to make those $8,000 contributions, but their salary exceeds $150,000. That $8,000, you can still make it. You can still make those catch-up contributions, and you may very well need to or want to. But just know from a tax standpoint that $8,000 is now going to be taxable, where 2025 and before, you could make that $8,000 and it actually reduce your taxable income for that year.
I understand. It just seems a little, I don't like it. I'm just going to say it.
And this is kind of the short side. Obviously we've got politicians who are making all these rules, right? So where this comes in, kind of think thought process, and we can go. You can actually go back to the episode we did on the One Big Beautiful Bill Act as well, where the whole idea here is that Congress is looking for opportunities to increase tax revenue. So they're still allowing you to make the contributions, but where in the past that $8,000 would have reduced your taxable income, meaning less tax revenue, by requiring that $8,000 go to the Roth side, now you're having to pay tax on that $8,000.
Okay.
So that's where all this is coming from. Now, for our standpoint, as the workers and the people planning retirement, that means that $8,000 is tax-free for the rest of my life. So if I'm 50 and I retire at 65, what is that $8,000 going to grow to? So if it's $30,000 by the time I actually retire, that's $30,000 that's tax-free that Uncle Sam doesn't get his hands on.
I do like that part.
You got to look at it optimistically as best you can.
Yeah. Well, I leave that to you, Eric. You're very good at that.
I appreciate it. Yeah. So you got to be optimistic as best you can, looking for the future.
All right.
So now let's talk about a situation as we get ready to wrap up here. Think about a situation where that actually occurs a lot of times with our audience, women who are 55 plus, who might have had to, for whatever reason, step out of the workforce. It could be a temporary situation. It could be a caregiving scenario. But that is a very common situation where maybe the spouse has to take caregiving for your spouse, or you're caregiving for a parent or any other family member. But you're in a situation where maybe you don't have earned income for the current year. Not having earned income does not automatically mean retirement contributions are not possible.
Okay.
But here's what's called the spousal IRA rules. Spousal contributions come into play. So as long as one spouse has earned income, that income can be used to qualify both spouses for an IRA contribution or a Roth contribution, as long as you're filing jointly and the working spouse has enough earned income to cover both contributions. Okay. So for 2026, as an example, that means if the working spouse would need to have earned at least $15,000 in order to fully fund 2 IRA or Roth contributions of $7,500 each. And where we see this a lot is where maybe one spouse is fully retired, or they're serving in a caregiving capacity while the other is still working, maybe still working full-time, maybe doing part-time work or consulting work, where there's still some earned income. But even if you've just got a little bit of income, it might potentially allow both spouses to make these contributions, especially if you're thinking about like Roth IRAs, where we're looking at the benefit could be potentially twofold. Number one, if you are still in your working years, that can help. If you're out of the workforce, maybe that helps you keep your retirement savings on track a little bit, especially again, if it's just a temporary situation where you plan to go back to work, but you're just not working the current year, helps you not get too far behind on your retirement savings. But it also, again, using the Roth example, that potentially allows you, if you still got earned income, maybe it allows me to diversify my retirement assets a little bit more, get some more, because so many people, because that's kind of what the rules dictated, so many people have a significant portion of their retirement assets sitting in those pre-tax accounts. Meaning, again, in many cases now that we've got people retiring, they're having to pay tax on those dollars. Or it's triggering high required minimum distributions. So different things like that will happen because all their money, the significant majority of their money, is sitting in pre-tax accounts. Maybe this allows you in those early retirement years to diversify your retirement holdings a little bit by adding to your Roth accounts.
Yeah. I'll put all that money in the Roth.
Hey, tax-free is tax-free, right?
Exactly.
But again, assuming contributions if they're not possible for you, just make sure you understand those spousal rules, because again, it can make a significant difference, especially unfortunately if it's a situation where, divorce plays a role somewhere down the road, or a spouse passes away. If everything is in that other spouse's name, now that can create some other challenges down the road as well.
Okay.
All right. So putting this all together. So again, the 2026 contribution limits offer meaningful opportunities, especially during what may be both a transition as you're working towards those retirement years, and you're in your higher earning years, making sure you understand how much you can contribute and where you should contribute based on whatever prioritization strategy makes sense for you, and again, including how taxes fit into that picture. But this can help you better guide those decisions if you have multiple options available. Again, you want to make sure you understand some of these new rules that are just into effect as a result of Secure Act 2.0, such as that enhanced catch-up contribution, Roth-only contributions for high earners. Again, that's also an important planning today. And we're also going to include a link to our 2026 tax and retirement planning cheat sheet, which is basically, it's designed as a simple 2-page reference. It covers a lot of these key tax and retirement planning numbers that you're most likely to see as you're planning, or that you're going to need as you're planning your own retirement strategy for 2026.
Okay.
Got all that?
I do.
Awesome.
Don't quiz me, though.
It's up next. We're going to do another episode just on whether you picked up all that or not.
All right, good.
Actually, no, I'll just send you the cheat sheet. How's that?
I like that.
Perfect. Well, as always, thank you for tuning in. Thank you, Wendy, for being with me once again. If you'd like help thinking through which accounts to prioritize, how contributions fit into your tax picture, and what makes the most sense for your situation, you can learn more about our personalized retirement planning guidance and schedule a call with our team at getmysimplyretirementroadmap.com. That is it for today's episode. For all the links and resources mentioned today, visit the simplyretirementpodcast.com. Please don't forget to like, follow, and share the show. And until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
That's it for today's episode of the Simply Retirement Podcast. We hope you found our insights and advice helpful in planning for a fulfilling retirement. Don't forget to take action on what you've learned today. Visit our website at blakewealthmanagement.com to learn more about our firm and review our Simply Retirement Roadmap process to get you on the right path to the retirement you deserve. And don't forget to click the follow button to be notified when new episodes become available. Thank you for joining us on this journey, and we look forward to helping you achieve your retirement goals. Remember, retirement is not the end of the road. It is the start of a new journey. So embrace it and make the most of it. Until next time, take care. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor, Blake Wealth Management, and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.